Good day and salam sejahtera to Professor Madya Dr. Saiful Hafizah Jaman. Our group presentation topic is building investment portfolio that enhance shareholders' wealth. These four tables are the descriptive statistics for 4 shares chosen. The green color boxes show the highest average weekly return in a year for each share respectively. The gray color boxes are the overall standard deviation value. We can see that 4 shares have low standard deviation value, meaning that they are low risk and low volatility. The blue color boxes are the overall kurtosis value. When data follows normal distribution, the kurtosis value is 3. If the value greater than 3 means higher abnormal returns and vice versa. All 4 shares kurtosis value is below than 3, so there are fewer abnormal returns happen to these shares. Pink color boxes show that all 4 shares have positive skewness. This indicates that they generate frequent small losses and few extreme gain. The orange boxes show the overall range, minimum and maximum price shares.
Covariance is used to determine the direction of a linear relationship between two risky assets. If both risky assets tend to increase or decrease together, the coefficient is positive. If one risky asset tends to increase as the other decreases, the coefficient is negative. Besides, correlation coefficient is used to measure the dependence between two risky assets. From the table, all the absolute value of the correlation coefficient is less than 0.3, so it can be concluded that there is no linear relationship between any two risky assets. The determination of the optimal risky portfolio is based on the past performances of the risky assets. Hence, the result obtained show that regardless the combinations of the risky assets in the portfolio, the optimal risky portfolio P is a portfolio which fully invested in stock DBEG, as is the only stock with positive average returns. Based on the Markov portfolio selection model, everyone will invest in P regardless his or her risk aversion. An optimal complete portfolio is a portfolio which consists of portfolio P and risk-free assets. So, the capital asset line indicates the optimal complete portfolio at different level of risk. Hence, a more risk-averse investor will choose to include certain proportion of risk-free assets in their portfolio, while a less risk-averse investor will choose to borrow at risk-free to invest more in P. So, different investors will have different optimal complete portfolio based on their preference of risk.
PUBM share price tended to move 0.0081% for 1% every move in KLCI index. An increment in sectorial index will increase PUBM stock price by 0.0047. PUBM's true beta is not 0, whereas alpha might be 0 for both index. Observe that an average 0.0092 increase in DBG stock price with an increment 1 in KLCI index, whereas an increase in sectorial index will cause DBEG stock price increase 0.0066. The true beta and alpha of DBEG shares with both market index might be 0 as the p-value is large. Enzo stock price rising by 0.0081 when KLCI index increases an amount of 1. An increment in sectorial index will increase Enzo stock price by 0.0018. The beta and alpha estimates of Enzo shares with both index is statistically insignificant. Observe that an average 0.0095 increase in THSP stock price with an increment 1 in KLCI index. Also, an increase in sectorial index will cause DBEG stock price increase 0.0133. Both beta estimates is statistically significant, but both alpha estimates are insignificant.
Generally, Sharpe ratio gives an idea of how much extra return an investor is earning in the volatile market for holding a riskier asset. In contrast to the Sharpe ratio, which adjusts return with the total risk of the portfolio, Trainer ratio uses the systematic risk, whereas Jensen's alpha explains whether a portfolio has performed better or worse than its beta value would suggest. For the Sharpe ratio analysis, the best investment portfolio should have a highest Sharpe ratio value, while for the Trainer ratio analysis, a positive ratio shows that an investment has added value in relation to its market risk, while a negative ratio indicates that an investment has performed worse than a risk-free instrument. Whereas for the Jensen's alpha analysis, A positive Jensen alpha indicates that the portfolio earns even more than the risk-adjusted return. Therefore, by comparing three types of portfolio combinations, we are convinced that the arrowed portfolios are better portfolio choices for investment. As a conclusion, these portfolios have the same Sharpe ratio and trainer ratio due to the optimal achieved when fully invested in DBEG. This means that diversification of portfolio failed to be achieved. Although the return of the DBEG is higher than the risk-free asset, its risk is also higher. Therefore, it's better to invest in the risk-free asset as the return is fairly the same while bearing no risk.